What's up, YouTube? Stocks by the numbers. Welcome back. Looking at ChargePoint Holdings today, ticker symbol CHPT, listed here on the New York Stock Exchange. I'm sure you guys seeing this stock trending down over 35% right now, down $1.11 at $2.02, hitting new lows of $1.95, recently getting a lot of price target downgrades, and of course, changing up the CEO and warning that revenue may continue to remain kind of inconsistent. And unfortunately, this is what is beating up the price of the stock right now. Again, down about 35.33%. This is why I always say you're better off missing a small rally in a consistently growing stock and knowing that you're getting in at a decent value and there is more value to come down the road, as opposed to trying to time a bottom on kind of a crappy stock like this, in my opinion. And, just trying to come out the other end looking like a genius. Oh, I'm buying it here at 2. I knew it was going to go up to 9. No, you didn't. Right? Let's stop the BS. No, you didn't. But at the end of the day, where do I think it's going to go? Well, honestly, the low, 729 million market cap right now. I'd say the low, they could bring it maybe in line with last year's revenue. So potentially maybe about $500 million market cap, which of course would be, maybe like a close to another 30% drop or something like that. So we could get down to like 150, sub 150. It definitely is possible. This is a 5-year chart, I think. Yeah, there's a 5-year chart, and you can see the 5-year fib down here at $1.80. And if we switch over, see, even on the year to date, you have 178. So that's looking like around the key level. But on the 1 year also, 178. And obviously, when you go on a shorter time frame now, it's below all of these fib levels. But as you see, it's going to try to hold around $2 a share. We were in a symmetrical triangle for several hours. Now the stock is literally completely flat, lying like a rug right now, barely doing anything for almost the last hour now we're looking at. So, could go either way. As we see, the moving average has been slowly dropping down. Now the 20-day moving average sitting at like 207, 206. So that's why even with the markets trying to go green again for some reason, we can see that chances are, in my opinion, we're either going to reject here or just drop in the last hour. In my opinion, I think it does go back down to sub $2. Believe it or not, even after this big drop, I would still not be a buyer. But again, this is why I make these videos, because if we zoom in, again, we can see that, I said personally that I wouldn't buy it, and then we started to sell off a little bit, so, it looked good, and then you have that random bounce, probably because it was a little oversold, and the stock runs up to 3.5. So the one thing I will say is, see, it's these pops like this in companies that I feel, in my opinion, should be going lower, that when they go higher, if you happen to get in, you have to take the money and run. Because as you see, if at 280 we felt it was overvalued and then it immediately started selling off, but then you have a pop up to 340, 350. Well, if we thought it was going to sell off at 280 and now it pops up to 340, 350, you have no business trying to be greedy, looking at it saying, oh, it's going back to 4, I can make even more money. You did not even deserve this pop here. But the market gave it to you. So if you were in, I hope you got out. I really do. And it unfortunately, these plays are very easy to call, not to sound cocky, but when I look at these other companies, like Laser, ChargePoint, even like Fuel Cell, right? I said it was going down. Plug Power, I said was overvalued, should consistently drop down. It's much easier to call, believe it or not. And the reason why it's easy for me anyway, again, I'm not trying to brag, but the reason why is because here from day one at $10, it was overvalued. From day one, it was overvalued, right? The company now is bringing in more revenue than it did back here at this time. And of course, it's inconsistently coming in. But the stock was 5 times higher than where it is now, giving us a $3.5 billion market cap. $3.5 billion market cap. And then when revenue comes in, yeah, listen, nice 10% beat there on the first quarter, but you only made $40 million. You only made $40 million. You know, that's what I mean. Up to 60, up to 80, like, listen, up to 100. These are great jumps. Don't get me wrong. These are great jumps. But even at 100 million a quarter, that is, we'll call it 4 to 500 million, we'll say, for the year. And you come out with a market cap of several $billion when it took you, you know, a year and a half to start making even 100 million a quarter. That's why here at this current valuation, listen, again, coming in above estimates, fantastic, off to a good start. But 40 million times 4 is 160 million, even 200 million for the year. But you came out at 3.5 billion, and then we brought the stock up, 300, 400%. This is what I'm trying to show you guys. Companies that make, a couple of million or, 50, 100 million for the year, those are not multi-billion-dollar corporations. And it's unfortunate because sometimes Wall Street tries to show you that they are. So we can't really write it down as a rule. But in my opinion, this is why sometimes you just have to take a step back and use simple logic and common sense. If it wasn't overvalued at 10, the stock would have held 10. That's a fact, right? That's what it comes down to. That's what it comes down to. Everyone bought into the hype, brought it up to $50, and then the stock has been in a downtrend for whatever, 2.5 years, 3 years, or whatever the hell it's going on. And this is what I'm trying to show you guys. Again, I know I may not know everything about everything. I may not look at the specific fundamentals that you may look at, or I'm missing technical indicators that you look at. Or, I'm drawing trend lines when everyone else is, spotting patterns and whatnot. I'm doing it a little different. Or, I've had people comment on my videos, oh, you're just going with, like, these gut feelings, like, there's no way that can be successful. Well, hey, listen, I'm not perfect. And, I might not go 10 out of 10, but like I always say, if we can keep it 7 out of 10, 8 out of 10, maybe 9 out of 10, you have to be on that better side of 50-50. So you may not agree or like or appreciate my voice or the way I look at stocks or what I'm bringing to the table, and I can totally understand that. Again, we're all different. We all like what we like and don't like what we don't like. But if what you're doing is not successful most of the time, then you're either doing it wrong or just looking at the wrong data and just looking at the wrong things. That's really what it comes down to. So you may be able to tell me everything about ChargePoint and where they're going to be 3 years from now, and you may have left no stone unturned. There is not a single iota of information on a stock like ChargePoint that you personally have not taken into account. And you can probably run circles around me when talking about CHPT. But I did know one thing. Up here at 7, when someone asked me about it in Discord, I knew it was going down. When we last looked at it on November 6th at 285, I knew it was going down. And this is why sometimes they say, like overanalysis by paralysis, or, don't overanalyze a situation. That's what I mean. This is what it comes down to. Because if you try to find positives, then what's going to happen is any little slight thing you're going to try to view as a big positive. And again, I know some of us are doing well, some of us are struggling right now, but the main point was that, if you're just following, let's just say like RSI indicator, and you're just buying stocks that are oversold and selling ones that are overbought, if you're right like 40, 50% of the time, that is not a good strategy. If you're constantly, trying to look for bullish hammers setting up so that you can time the next leg higher, but you're only right like 50, 55, maybe 60% of the time, you may need to reevaluate your strategy. Because I'd say, in my opinion, at minimum, You need to be right 7 out of 10 times to consistently grow an account. And of course, other things come into to account as well. You know, like these little rules, you always have to keep cash on hand. You should always be slightly diversified. You should always have, 1 or 2 hedge positions in case your other plays don't work out. You should never invest, 80, 90% of your account value into one position. And unfortunately, again, as much as there are a lot of YouTubers out there trying to help people on the finance side, unfortunately, it really all comes back down to time and experience. A lot of people just don't know what to do. But also on the flip side, a lot of people are very set in their ways and very stubborn and kind of refuse to open their mind and see different strategies and, try out, go down the untraveled path, so to speak, to try to discover something new. But again, at the end of the day, sometimes it just comes down to simple logic and common sense. That's why, again, when I look at stocks like Plug or Laser, if they're overvalued, like that's it, I wouldn't be a buyer. Even something like Palantir getting up to, 16, 17, as much as you guys like the stock, at the end of the day, it's overvalued in the numbers. And that's what I mean. Men lie, women lie, numbers do not lie. That's why I like looking at the numbers. And, it could be the lone spot here, but as you see, I was expecting the drop here out of the symmetrical triangle, and I expected the company to take a little bit longer to have this explosion because it was overvalued at this point. So I was expecting it to kind of slowly come back down to earth and then rally up when the revenue caught up with the market cap. And of course, that is not what happened here, right? We look at a quarter like this, they beat earnings. They came in above estimates on the EPS side, and they were talking about going net income positive sooner than they thought, so the stock absolutely exploded. Look at this. 775, we'll call it, straight up to 1720. That doesn't happen, right? The value of the company should not have increased 150% just because they came out with some good news this quarter. Because again, at the end of the day, it is the revenue that is going to keep the company up. Now again, I'm glad they, came out net income positive and everything like that. And then look at the next quarter as we see here. Now they missed on revenue. So you come out with such a great quarter before, and the stock goes from 7 to 17, but then the following quarter, you miss on the top and bottom lines. Which means that technically, by previous logic, the stock should have went from 17 back down to 7. But it didn't, as we see. It dropped down to the high 13s and then rallied and bounced higher back up to the 20 range. And then we come in with another beat and another big beat there on the EPS side. So now it's climbing up to the moon. Of course, it's forming a wedge and should really drop down, but obviously this stock has been just really taken to a valuation that is so unrealistic, it is very, very hard to call. And again, you have to take what the market gives you. And right now, the market is giving us a company that made about $2 billion last year, has a market cap of $44 billion, and a PE of 305. So that's what I mean. A stock like this should actually be coming back down to earth, as I keep preaching. But it doesn't always happen. And that is why it's almost impossible to look for these concrete rules. What is a concrete rule? Well, when bond yields go up, stocks go down. Well, we've seen lately that's not always the case. I don't know what the hell's going on with this market, but, that's another story. People talk about the dollar and the relation it has with the value of the indices. Oh, when the dollar goes down, stocks go up. When the dollar goes up, stocks go down. Well, that's not always the case also, because we've had days where stocks were green and dollar was green. So that's why, unfortunately, as much as we want to follow these rules, they're never really completely set in stone. But Yeah, I know I went off on a little bit of a tangent there, but long story short, you're not forced to buy into anything, right? So that's why I brought up Palantir as an example. Even right now, with all the good news they've been reporting, excuse me, with the stock up here north of $20 a share, a 40 plus billion-dollar valuation, I'm sorry, I wouldn't be a buyer. I wouldn't be a buyer. And again, I'm just trying to show you that in my opinion, the way I'm looking at it, it comes back to the numbers, right? 2 billion in revenue for the year, $44 billion market cap. I mean, you probably can't give me a long list of other stocks like that are trading 22 times annual revenue. And that's the point I'm trying to make, right? It's like occasionally you'll run into the exception to the rule. And it is what it is. But again, numbers don't lie. And the big difference between a stock like ChargePoint and a company like Palantir is the fact that Palantir has been more consistently coming out with positivity, and obviously ChargePoint is been very inconsistent, which is what I said from day one. And now you come out today and say, oh yeah, revenue might get rocky moving forward, and by the way, we're changing up the CEO. It's like, yeah, man, yeah, everyone's jumping ship. People don't want to hear that now. Are you kidding me? You're 2 years too late. So that's why, again, people may disagree with the way I look at things. Oh, you're just going with your gut feeling. Hey, listen, my gut, let me tell you something. My gut has been right at least 70 to 80% of the time. I may not get every call right, but whether you agree or not, I think I'm going to keep trusting my gut. Going to stock charts here, just very quickly, I'll let you go because, again, I talked more than I wanted to. But we can see here the moving averages are now drastically higher than where the stock is because the stock was fakely overinflated due to kids buying the stock with stimulus money. And now we had a MACD that was climbing nicely here with this November rally, and now you can see that obviously we turned back towards the downside, and in my opinion this will probably keep slipping, flatten out, and then cross to the downside, which is why I'm looking for that $1.80, 178 minimum. Could go lower than that. RSI sitting here now, sub 31. Obviously, that's not an indicator because we went several months with the RSI sub 30 and the stock really never rebounded for us. Switching over here on the weekly now, we can see that as the stock has been chunking down, the bottom Bollinger Band has completely widened out and dropped down. Bottom Bollinger Band now sitting at 118. That may be a little excessive, but it is possible. You can never rule it out. But in my opinion, that'll hopefully the stock will try to hold this $2 level for at least a couple of days so that the bottom Bollinger Band could begin to flatten out and curl and start to climb back up. So at least the bottom Bollinger Band could potentially try to get to maybe like 140, 150 so that that could potentially be the bottom of the bottom. And again, if the company is still anticipating, nice growth in the future, that unfortunately, we have to take the good with the bad and we have to weather the storm and ride it out and deal with these speed bumps and these obstacles. And hopefully down the road it could work out well for you. But probably going to take a couple of years. RSI here on the weekly at 24.5. Obviously means nothing. For months the RSI was sub 30. Didn't mean anything. Look at this 200-day moving average up here at almost $16, and the 50-day half of that at 8. That's why, in my opinion, it should take years for this stock to get back to these levels. So, MACD been consistently slipping. Did look like it was trying to reverse and start to curl upward there as we had these small little chunk ups here going into the month of November, but of course now we turn back to the downside and we'll probably consistently keep dropping there. And that's pretty much it. See, this is the difference. That's what I mean. This is why coming from where we came from, and again, I was in the industry for a couple of years, and At that time, I remember looking back to like the early 2000s to see like what stocks were valued at, like what kind of revenue were they bringing in, what was their market capitalization at that time, how did Wall Street value them. And what I'm seeing is this. You really, in my opinion, have no urgency whatsoever to buy any IPO stock. And I know that sounds crazy. I know that sounds crazy. But if you haven't noticed, what you're seeing is you're seeing an overvaluation right out of the gate from day one. Then, because it went public, everyone's hyped about it, and the volume starts coming in because everyone wants to own an IPO. Because everyone, for some reason, just thinks if we just blindly buy shares at IPO price, oh, 5-10 years down the road, I'm going to retire on this stock. They don't all work out like that. As we can see, ChargePoint down 80% from inception. But the problem is it was overvalued from day one, which is why it has consistently dropped. And it's basically the same thing with all of these newer companies. And that's the point I was trying to make. When we look back and we look at stocks like Google or Visa, when these companies IPO'd, they may have been viewed as a little bit overinflated with their valuations. But the difference also was that the companies were already established, the companies were already bringing in revenue, and more importantly, investors, financial institutions alike, everyone across the board saw and had high confidence that this company would continue to grow over the months, over the years, and just consistently climb in value, and it's going to work out. And that, I think, in my opinion, is really the big difference now between IPOs today and IPOs even, 15, 20 years ago. Sounds like a lot of time, but it's really not a lot of time. And the problem is that a lot of these valuations have gotten so out of whack that, coming from when it was, I don't want to say realistic, because I feel overall the whole market is kind of BS, but let's just say coming from a more realistic valuation time frame, time period there. Now we fast forward to today, and I just feel like everything is out of whack. And that's why when we do find stocks with growing revenue, or they're starting to turn around the profitability side and narrow those losses, but again, consistent revenue growth quarter over quarter, year over year. We see a company that looks pretty healthy financially, and they brought in like $1 billion last year, but the market cap right now is like $1 billion, right? Those are the stocks, in my opinion, you guys should be looking for, because those are the stocks over time that really begin to chunk up and start taking legs higher. Because it may seem like the stock is stagnant and it's not doing anything, but at any given moment, the company could come out with a really good earnings report, blow away estimates, and then all of a sudden the stock's off to the races. Every hedge fund is adding a position to it, and that's it. It's just up and up and up. Perfect example. Super microcomputer. Perfect example here. Perfect example. We can go back even further, maybe. Yeah, it was like here. Like 2017, maybe. Yeah, it was back here. It was like 2016, 2017. And again, you can see the stock like 20 and change or whatever, but it was still trending downward. And, then all of a sudden after 2018, it just started growing like crazy and rallying up and taking huge legs higher. And all of a sudden it's $350 a share. And a lot of people may not understand what's going on here. And the whole reason why it looks so extreme is because of this stagnation here. For several years, the stock was essentially flat or even trending downward. And if we look now, even at this crazy high valuation, we can see that the PE is 26. But again, this is a tech stock. And usually, they used to say like the industry average, PE, could be anywhere from like 18 to 22, but we all know that tech trades at a higher multiple, so maybe you can go like 27 to 30 PE, right? The PE right here is only 26. 26, $15.5 billion market cap. Look at that growth. Look at that growth. Now, again, we're not looking all the way back here at 2015, but again, look at that growth. This is why I always say, well, quarterly, it looks a little choppy recently, but again, I'm talking broad picture, we're talking about like the last 10 years here, but this is why I say, look for the growth, follow the money. Because, you may have been adding to this position for years, just wondering what the hell is going on. When is this going to turn around? And then boom, $350 a share. Now think about how many people were buying this at 32, 28, 23, 19, and they're saying, wow, should I just cut my losses? Is this stock not going to work out? Blah, blah, blah. If the numbers are there, as we see, again, it took a long time. But remember, a lot of you tell me that you're buying these stocks for the long term and several years down the road, it's going to pay off, blah, blah, blah. So if you're already in that long-term mentality, then what I'm showing you is all you have to do is follow the money and follow the revenue. And this whole time, you add to the position. You build the position. And then, as we see, it seriously pays off. So, I know it's rough. I know I'm like all over the place here in this video. I don't even know really what I'm even talking about anymore. But this is the difference between, a stock like SMCI or even Palantir. Again, I may think it's overvalued in the numbers, but it did have the positive news to come out to back up the upward momentum. Right? So I can't sit here and say I have no idea why Palantir went higher, right? We know why it went higher. It's just too high. But we know why it went higher. And it's the same thing with ChargePoint. It's the same thing with Laser. It's the same thing with Plug Power. I know why it went lower. You might just be upset because you happen to own it and that's not what you wanted to see. But I know why it went lower. And it might be a gut feeling. It might be a very simplistic analytical view that you don't like and, you feel we should look at more things before making that analysis and that prediction. But at the end of the day, sometimes we know what we know. And there is a saying also, that the initial reaction, the initial gut feeling sometimes is usually the best reaction, or when you're taking a test in school, like the first instinct answer that you would have put down usually turns out to be the correct answer. So as much as, people may just want to knock my nonchalant view or my gut feeling analytics, sometimes that's all you need. And I'm going to end it there. So once again, this is Stocks by the Numbers. I want to thank you guys for stopping by. If you have any questions, comments, or concerns, let me know down in the comments section. I'm usually very quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. I'll do updates on these stocks. If I see a decent situation, I remember I saw a situation with Under Armour. I made a video. I brought that to your guys' attention. Didn't really work out. May have made some people a couple of bucks, but it didn't pan out exactly as we said. And listen, it happens. It happens. And, when things don't work out, we have to man up, bite the bullet, and move on. And I know it's rough out there. That's why I always say that I understand that markets are rocky and volatile and very uncertain. So I wish all of you success. I hope everyone makes a couple of dollars. Random Steam friend. I want to thank you for stopping by. Have a good day.